Okay, trade like a machine trading exercise. In brief, we give you a default trading strategy which you may or may not use for the purpose of this trading exercise. Read the drill on the website for some background on it. The idea is to take a number of trades with discipline, without breaking your rules, to take a lot of the discretion out of it. You'll still have some discretion in how you work bids and offers around the profile ranges, but we're giving you a basic strategy to trade with some rules that we don't want you to break. Now, the strategy itself is not necessarily a money maker, but the idea is that if you trade without making rookie errors or trying to predict the market each time you click the mouse, you can actually stay in the game a lot longer, and that gives you a bigger window to learn the nuances of your market, to develop your trading edge, and to develop some market intuition as to in line with your trading edge. So in this drill, we give you a basic strategy that first of all divides the market into low volume, normal volume, and high volume trading zones. Now, we use a pretty simple methodology for coming up with that. We draw some lines on a chart, and as such, this is Sierra chart, and we're just using the most previously completed 1 minute volume bar to tell us if we are in a low volume, normal volume, or high volume context. Then, depending on which context we're in, we have some basic rules to follow. And then on the bigger picture, outside of our rules, we have some basic money management principles to follow. Now, the brief background kind of comes from the Mark Douglas course, where they give you a specific task of executing flawlessly a trading system with X number of trades. The idea being that you get over your hesitation to enter and exit positions and overcome a lot of the rookie trading psychology issues that come with trading live. Now, we suggest doing this on the simulator still, and if you are taking this seriously and reviewing your trades and holding yourself accountable, you can get a lot out of trading on the sim in this manner. Otherwise, you have to look into getting some skin in the game or using some tricks to get you emotionally involved with your mechanical trading system. So, without blabbing on too much about the psychology of it, the system, as I said, divides the market up into low, normal, and high volume contexts. We do that by drawing some lines where our high volume contexts contain a number of volume spikes. Roughly half of the volume bars fall into the normal volume, and then we have the remaining in our low volume context. And we look at the most previously completed bar. So if we squash up our chart like we recommended in the drill, we have the previous bar is a normal volume trading context. So if we look at our rules briefly to give you an idea of how simple this is, in a normal volume, we're expecting a little bit more momentum behind moves. So that first implies that there is some directional bias obvious in the market. If you're looking at the gold DOM here, everything's a bit slow this time in Australia. In the jigsaw DOM there, we're seeing prints mainly into the bid. I'm going to make a assumption we're moving back into the range here, and what we're looking for in the normal volume context is to work offers then, if we're looking for shorts, to get a fill on minor pullbacks and then to manage the position from there. I'm not going to actually execute this trading strategy, as that'll be a lengthy video. I will record some actual videos of the drills. That's a brief outline. In the low volume context, we're always looking at the market current profile range. So if I'm to draw the current profile range here, just eyeballing it, this is our current profile range. So in a low volume context, let me get rid of that. In a low volume context, if we bring back up our Sierra chart here, which the previous bar was, we are waiting patiently for the market to test the extremes of this profile range. So we'd be looking at working orders in this area and in this area for the market to trade back into the range. There's no guarantee that is exactly what's going to happen, which is why we give you a number of outcomes that can occur. If, for instance, you are working orders in this area and you get a fill, and then the market, as they say, gets in your face, and you then want to be as efficiently as possible exiting and minimizing the damage if the market breaks out of this profile range. And that is a successful trade. If you can get out of the market with only a 1 or 2 tick loss, that is a successful trade. If you find that you're holding on and the market's then 5 or 6, 10 ticks against you, you've definitely made a rookie error if you've been paying attention to these trading drills, which are all around short-term. I won't say scalping because there's different definitions of scalping, but just very short-term trading positions. So in the normal volume context, we're looking for the market to trade back into the range. The low volume, that is. In the normal volume, we're looking for pullbacks and a bit of momentum. So as I just mentioned, gold is now trading down in this quiet trading period. We'll be looking for pullbacks. In our DOM, we're just reading the order flow here, which is why we recommend having the chart squashed up, so you're not tempted to find patterns in the 1 minute volume bars. The discretion will still be there, as in you will have to decide, okay, this is a minor pullback, and you can tell if it's a minor pullback culminating using the previous trading drill skills you picked up. If you haven't completed any of them, you're looking for some absorption at the offer, or just some change in the motion of the market, and with a bit of patience you can see the market hold instead of expecting it to immediately bounce back down. That sort of behavior occurs more in the high volume context. Now, at the risk of confusing everyone, I'm going to stop there. It's clearer to read the trading exercise on the website. I do have one other tip for you, a bit of a plug for PriceSquawk. If you are using the Jigsaw trading tools, this is their day trader platform. Instead of referencing a bar chart, as I've said in this exercise, you can actually open up a PriceSquawk and enter your volume conditions here. So let me expand this chart and show you how you would translate that over. We have this bottom bar, red bar. I don't know if you can see that. Okay, so we have just eyeballing the 1 minute chart, we came up with a value of, let's say, 60 contracts traded in 1 minute. So we're going to set, since we're talking about the amount of volume traded in a time period, volume in time, we will set our minimum value to 60. So above 60, we're in our normal volume trading context. Now this upper bar here is, let's say that's around 180. So PriceSquawk will now just tell us what trading context we're in terms of volume. You will have to just set up a few things here. This is the next version we're releasing, so the wizard makes it a bit easier. We're not going to use the squawk, no, tape, No, we're using alerts. Do you want to hear alerts for volume and size? Yes. We've entered our values. Announce alerts using the speech engine. You can click that and enable volume alerts there. That's all you need to do. So now we will receive alerts announced for 60 contracts traded or greater than 180 contracts traded, and those are what we will use for our low, normal, and high volume contexts. I have it muted so we won't hear anything. Okay, so you can actually configure it to announce the number of contracts traded, or we'll just use a more general minimum, maximum announcement. And we're only using 2 trading zones here, so we want to hear if volume increases above the minimum value and above the middle value, and if volume decreases back into the middle value and below the minimum value. So for example, to know if we're in the normal trading volume conditions, you'll hear a minimum volume alert. These are just demonstrations of it going back and forth between the contexts.
Middle volume.
So you'll hear a middle volume if it goes into a high volume context. I could probably make that a more logical. Let's set middle to 60, 180, and we'll disable our minimum alert, or just turn the volume down on that. So
middle volume. Max volume.
if you copy this setup, and what I'll do is I'll save this as the trade machine setting and put it in the video notes so you can load it. So when it's above middle volume, we know we're in
max volume.
Okay, so we're currently in a maximum volume context. According to our rules, we don't even have to trade a maximum volume context. So we're successful trading a high volume context, even if we don't take any trades. But if you do place trades, then we're looking at major reversals and major breakouts. I'll leave that more for a actual trading drill demonstration. I suppose one question I have got is, there are obviously on 1 minute bars it is going to jump around between zones. Always use the most recent announcement from PriceSquawk or most recent trading bar. So the last bar was a high volume context, the last complete bar. We're still in that high volume context then. So we're looking for a major reversal, and there's some information in that trading drill on how to play that.
Middle volume.
So now we're in a normal volume context and we're looking for pullbacks. You'll find that during the main session, volume will be more consistently within these trading zones for a period of time instead of jumping back and forth. So that's how that's one tool that can simplify this trading drill. And yeah, let me know if you have any questions or if I've just confused you more, and I can put something together. Again, I'm planning on making these videos fairly informal, just because otherwise it takes me a lot of time to put them together. So hopefully you got something out of this on Trade Like a Machine trading drill. And remember, we are just giving you a default trading system. You can use, if you've been doing the other drills, you might have come up with some unique rules of your own that you want to use. And if you've read the trading drill notes, it doesn't have to necessarily be a money-making system. The idea is that you have some rules to follow, and you're trading according to those rules and the basic money management principles we laid out there. You also want to do this for at least a couple of weeks, because we really want you to test yourself in discipline while executing these trades. You'll know if you've broken a basic rule. You'll know if you're starting to try and top pick or entering when you're not at the boundaries of the profile in a low volume context, or just getting too trigger happy when your rules say that you should be executing patience, waiting for a pullback, for instance. And exercise 1 actually gives you some review principles that you can use, so you can look back at your 1 minute chart at the end of the session and gauge whether you were following a plan and how well you were doing that. All right, that's all for now. Thank you for watching. Cheers.